to say that investor sentiment around food tech has soured somewhat in recent years, but specialist investors are in it for the long haul, says Synthesis Capital.
The first wave of these companies in the protein space, which is now over a decade old, they understood the problem. They didn't have the right solutions for that. And actually, we were also in a 0% interest rate environment, which was grow at any cost, and all sort of business fundamentals weren't aligned there. So that, yes, didn't work out. I think, are we seeing a second wave? Yes, for a few reasons. One, the reasons that these companies exist are still there, maybe even more acute, right? So the climate problem, look at all the wars, we were just talking now about what's going on in politics, look at all the wars that are happening all over the world, food security is a big issue, so all of these things still need to be solved. And actually, the innovation and the technological progress that's been happening hasn't changed. Actually, what's happening now is founders, for lack of a better phrase, have their head screwed on right in terms of, burn, growing slowly, how much cash they know that they're able to raise, building more solid foundations for these businesses. And certainly for us as investors with lots of dry powder to invest in the space, it's a much better time now because we're seeing better valuations, and also you're seeing these innovative startups that are a bit more realistic about how they can perform. Or the best advice we can give to companies is don't get over your skis in terms of trying to overreach and focus on what you're doing. I think build, focus on your key sort of products that you're looking to build. You make sure your unit economics make sense. Don't be asking investors to fund negative gross margins and losses for a very long time, which is tough, by the way, for some things like cultivated meat, etc. And there will be a place for those, but I think a much more realistic and sort of small raises at various points in time, rather than I'm going to try and raise $100 million now, which is just not happening, is the advice I would give. So we invest, as you know, in upstream enabling technologies that will power the future of food. That may be in food, that may be in biotech and other areas. So we avoided purposefully the kind of plant-based CPG bloodbath that's been going on. I think where we've become a little bit more flexible, Elaine, is recognizing that as companies ride the cost curve down, they may need to access other markets outside of food, biotech, biopharma, etc., where there are more enterprise level customers that will pay them for these products. We've made a bit more flexible, where as long as the food angle is there at the end, which is the mandate and what we're trying to invest in, and that sort of $5 trillion food TAM is available, we're a little bit more flexible about that, and we're looking more broadly, but it's very much still within the same enabling technologies upstream space. You had companies in the early space which said, right, I will leverage CMOs, I will leverage effectively an existing biopharma infrastructure to try and make food which needs a really low price, which didn't work, right? So unless we are now in a 5% interest rate environment going to raise billions of dollars to build lots of facilities, which there's no real appetite for new technologies and new products like this, these enablers really have a shot at improving things. So continuous fermentation is one. There are a couple of very interesting companies out there like PowBio and others, certainly here in the Bay Area. That can lower your cost by 50 to 100% to more than that with existing steel in the ground and existing CapEx. So that's one. Companies like Triple Bar as well, which is in our portfolio as well, with respect to kind of increasing titers and improving. So not changing anything with respect to physically what you have in your infrastructure, but actually through dialing in the process, your organism, and how you're working it, you're cutting 30, 40, 50% of the cost in the chain. That's what really excites us, and I think that's what's needed to get these food products there, because price has always been we talk about taste and texture and other things, but price has always been a key issue, and to some extent still is. The public markets are by no means widely open for companies now, right? Acquisitions are not really happening now. So my advice again to companies is just focus on your product, make sure your unit economics make sense, make sure you're making something that consumers want to buy so that you can make a margin, and if you have a partner or you're partnering with big companies, make sure that there's a margin for them as well, and actually the capital and the exits will flow. But we are in a difficult period now, not just within food tech, but in general with respect to the capital markets, especially with the sort of uncertainty that the new US administration is bringing into play, where it's going to be tough like that for a while.
What about, do you expect to see more consolidation, more kind of distressed M&A activity? And also, what role do you expect kind of corporate strategic to play in the next year?
So definitely consolidation. We've seen some of that, right? Unfortunately, a lot of it has been distressed, as you mentioned, and companies going bust and others buying assets. I think in the sort of broader sense of the word around M&A and acquiring and corporates, I don't, in the next 12 to 18 months, and I'm generalizing here, I don't think that would be a great time for big corporates to buy, for a few reasons. One, from the startup, and speaking as a startup investor perspective,
Yes.
I don't think you're going to be seeing the value of
Yeah.
the technology that you've put together. So I'd
Yes.
rather keep funding these businesses for a period to achieve
Yes.
milestones. But also from the corporate's perspective, the reason they're buying and acquiring and looking at these companies is because, again, sorry to say and to generalize, but big companies are really bad at innovation, right?
Yes.
And they want these startups as almost an outsourced R&D arm to try
Yes.
and do that. And startups generally in our space, I don't think are at a level where they can, a lot of them where they can slot in. So
Yeah.
next 12 to 18 months, I don't think there's
No.
going to be huge value seen
Yes.
from that.
Yeah.
But I think the best thing that corporates can do with startups now is partner in a clever way, whether that's JDA or something else. I think the startups have been humbled now and realize that actually they need the distribution channels and the fact that these corporates own the customer and all of their sort of know-how. And I think the corporates also realize, for the reasons we discussed, that they need effectively the R&D innovation of these corporates. So partnering together to actually bring a product to market is probably the best thing you could do now, rather than trying to buy an asset and bring it in-house and try and build it within a big corporate.
Again, talking about enabling technologies, every single startup now has got AI in its pitch deck. How do you, as an investor, assess whether that's just kind of hot air or whether that is, meaningful and transformative to the businesses you're looking at?
It's definitely an interesting space. I
Yeah.
mean, I haven't attended many of the panels here, but the AI one was
Yeah.
packed house. And everybody's using AI in their pitch deck. I think it's not an easy thing to do. It's definitely, everybody's got AI on their pitch deck, and it's almost like everybody has to have it now because it's expected in some way. I think it can definitely have a lot of impact in our space. For us, we brought on sort of advisors as a fund to help us assess AI, because we're not
Yeah.
AI investors. So that's how we're dealing with it. I think the key here is just understanding the data set, right?
Yeah.
Language models and all these sorts of processing engines
Yes.
are becoming slowly commoditized. Biology is very complex, and
Yes.
so the data you can generate is actually where the value is.
Yes.
And so if a startup has AI in their pitch deck but has no data, or thinks they're going to buy data off some public database, not interested, there are some very interesting startups that are generating.
Yeah.
To hop back on another one, portfolio, but Triple Bar, for example, is
Yes.
generating tens of millions of data points a day.
Yes.
And that potentially is very interesting from an AI engine. But the data is key for that.
Yes.